What I hope to do in this last hour is maybe summarize, maybe bring together a lot of the ideas that have already been covered. I'm a huge fan of Jake Bernstein. What an incredible mind and an innovator in the space of technical analysis. Jeff mentioned the CMT Association. CMT stands for Chartered Market Technician, not country music television or certified massage therapists or whatever else you might associate with the acronym. And so I'm not speaking on behalf of myself, but on behalf of the whole global community and our board of directors and the many men and women of Wall Street and Bay Street and Dalal Street and everywhere else in the world that have contributed to the body of knowledge that we define for responsible practitioners and professionals in the field. So let's dive right in. The organization exists for two purposes. We're here to help people improve their investment decision-making, investment performance through process and tools. So that might be you. And we're also here to help open up career opportunities, to make sure that the wider financial services industry understands what we mean by technical analysis and how responsible practitioners approach markets using these tools to help differentiate from perhaps some of the less responsible work that's out there. We do that through a number of different things, including professional ethics, a lot of educational content for and on behalf of members, of course, the credentialing program, which I'll talk about a little bit, and then that wide global professional network. And I think for everybody on this line, you've probably already felt that feeling of trading can be a little lonely, it can be isolating, and it's really great to have a network of peers to help you understand what's working, what's not working, test out ideas, get some feedback, be a part of a community that can help elevate your game. So a little background on the association. If you've never heard of the CMT Association, it's actually over 50 years old now. We celebrated the origination, the final filings of a New York State nonprofit from 1973. We had a wonderful event in New York City in April celebrating the practitioners and the money managers who use these tools. It was a great conference, a lot of learning, but that 50 years incorporates a huge dramatic shift, not only in the toolkit, the way people express technical ideas and look at markets today versus what we were doing in the late 1960s, but also the group has expanded greatly. It started with a very small team of equity sell-side research analysts from firms like E.F. Hutton and Smith Barney and lots of large bulge bracket brokers that don't exist anymore. They've all been gobbled up. And when we look at the organization now, it is a global endeavor, credentialing body incorporating 10,000 candidates in the CMT program, thousands of members worldwide in over 137 countries. We work with universities far and wide. Unfortunately, that program didn't exist when I was going through my MBA program. It was a pretty strict diet of fundamental analysis, but the CMT Association is working hand in hand with academia to help expose the next generation to how these tools can benefit them in their work. So this slide, I could spend all day talking about the history of the organization. We actually wrote a book on the 50 years of both Wall Street history as well as the association's history and the interlinkages there. I'll just point out a couple things to you. The CMT program actually didn't get started until 1989. It was a member organization for the first 20 years or so. So the first class of charter holders were in 1989. And you fast forward to, it was actually 2004, FINRA was starting to introduce a new series of regulatory exams for research analysts. Our board of directors and folks like Ralph Acampora and others stood up in front of the SEC attorneys and just sort of explained to them what the CMT program was about, the rigor, the breadth of coverage, the body of knowledge, the formality of how that was constructed. And now FINRA recognizes two types of analysts on Wall Street, fundamental analysts who carry a CFA and technical analysts who carry a CMT. And so with that recognition from FINRA, it really just expanded the reach and the brand identity for CMT charter holders. And that led to projects that we have ongoing with IROC in Canada and SEBI in India, and the Singapore Monetary Authority, and Bursa Malaysia, and on and on and on. So we do a lot of regulatory advocacy work with our members and the governments that oversee the trading in their countries. We did open an office in 2018 in India, in Mumbai. So for those of you who are still online and residing in India, my goodness, it is late, but thank you for spending all night with the MetaStock team. And we have expanded our operations since then. I did mention the 50th anniversary. We were actually invited by the New York Stock Exchange for a wonderful ceremony, rang the closing bell, and recognized the contributions of this organization and its members over the years to trading in the United States, but also globally. So that culture of excellence, the kind of impact that the organization has had, I'm probably not doing any justice to the history of this organization in such a short little nutshell approach. But if you wanted to learn a little bit more and learn from some of the innovators in the space, CMT charter holders like John Bollinger, who invented Bollinger Bands, or Luis Yamato, one of the great analysts of our generation, you can listen to some of their inputs and some of their experiences, perhaps learn some of the things that they discovered along the way in a free podcast available wherever you listen to podcasts, and I do mean every app out there, but it's called Fill the Gap, and our goal is to help fill the gap of knowledge from the wider industry and for people who are new to technical analysis, help them understand the utility and the universality of these tools, but also learn from money managers who've been trading and managing money through multiple market cycles, in the hopes that perhaps we pay a little less tuition to Mr. Market and maybe learn from some of their mistakes along the way. So check that out. We're finishing up season 3, and the 36 guests that we have had cover wide range of job roles in the industry, and these men and women have a lot that they have contributed over the decades. So make sure to check that out. The other thing I wanted to invite you all to is our next event that's coming up in Dubai on February 29th. Yes, we're moving it outside of New York City. We recognize the global nature of our membership, and what a perfect centralized location for all of our members across Asia, across Europe, and across North and South America to join together. That will be at the Museum of the Future, an incredible venue from the Crown Prince in Dubai in the United Arab Emirates. So that'll be, we'll kick off on the 28th, full day conference on the 29th, and our gala dinner will be that evening. Meeting face-to-face is, yes, less and less common post-COVID, but we find that the opportunity to do that every once in a while is incredibly powerful and a very enriching experience. So if that's you, feel free to head over to our website, cmtassociation.org. A lot more details about that event, and we'll have that full agenda of speakers up there. All right. That's enough preamble, a little introduction of the organization. My name is Tyler Wood. I am a CMT charter holder, so I've been through this whole program that I'm going to talk to you about. And being a charter holder in the CMT is it's a really powerful experience. I will talk to you a little bit about the link between fundamentals and technicals. It's taken me quite a bit of time to learn that, but in all of the presentations that I give all across the industry and across academia, there's really a very simple agenda. And there's 3 things that I hope we can accomplish here in the next 45 minutes. First of all, we have to define what we, the CMT Association, mean by technical analysis. And it's important that all of us have a shared common understanding of what we define these tools to be, what is the body of knowledge, and how do we use that to our advantage. The second, I'm just going to touch on 3 really simple technical concepts. Not really diving into any one indicator, but hopefully something that's very broad and overarching that could help you in your trading, and perhaps lead you to explore our third item of note today, which is thinking about a credentialing program, an organized and structured way to study technical analysis to help improve your own decision-making and really develop your own process, as opposed to just trading the way someone else has taught you how to trade. Think instead about getting to the root cause of what those indicators are trying to tell you, and then how you're going to make a process, a rules-based, systematic approach to trading. All right, so that's our agenda. Let's dive into the first topic, which is defining technical analysis. And yes, it is very mathematical, but no, we do not use the abacus anymore. In the late 1960s, when this organization got started, technical analysis was done by hand. And I think for almost everybody in the industry, the definition is that it starts with a chart. Technical analysis is a way to gather tons of information, lots of data from the market, and to put it into a visual form that helps our human brain process that information, make sense of it very quickly. So big data and AI, we've been talking about this since really since the 50s. There's been a little bit of an AI winter for some time, and now it's all the rage. Well, the idea of crunching big data actually goes back to the rice pits of Osaka, Japan, to a gentleman named Munehisa Homa, who understood that he could find a trading edge by understanding what trading was happening during the day. The man invented a system of organizing that data and giving himself a visualization that we call candlestick charting. I'm sure many of you look at candlestick charts, may not even recognize that those are hundreds of years old, and we have a gentleman named Munehisa Homa to thank. But when we go to the textbook definitions, I'm going to start with Edwards and McGee. That was sort of the foundational book of note in the 1940s. These gentlemen were writing about technical analysis, about some of the classical pattern studies, the importance of support and resistance, and they were just looking at price action, price behavior, a way of understanding the emotions and the drive of investors in an open, liquid marketplace. And they said that technical analysis is the study of the action of the market itself. So we're using what the market is giving us to help make decisions about what we want to do in the marketplace. And that goes back to some very foundational work, but we also know that they expanded on this idea, and they understood that technical analysis was really about supply and demand relationships for individual securities, for an equity index, for currency pairs, for commodities of all stripes, for fixed income instruments, you name it, across all asset classes, any liquid security. Its price is driven by supply and demand. We understand that price is set where a buyer and a seller meet. Now we're going to talk a little more about the basics of supply and demand, and then we also want to give a little more modern definition. This comes from Perry Kaufman, who's a widely cited author in the CMT curriculum. And he says that it's about the systematic evaluation of price and volume and other materials that are coming out of the marketplace. Now, Perry says that it's for the purpose of price forecasting. And I'm going to take issue with that. I apologize, Perry. I mean no disrespect. And I think taken out of context, many people think technical analysis is about predicting the future. I'm here to tell you that it is not about predicting the future. Nobody can do that. And anyone who tells you they can is probably pulling your leg. What Perry is talking about is using statistics, using probabilities, to position yourself as a trader on the right side of where the market is most likely to go. But we're not trying to predict the future. We don't have an opinion about what the future might be. We're using present information to react responsibly. And as that information changes, so too can our positioning with respect to the securities that we're trading. That term systematic, right? A lot of people give a lot of attention to algos. A lot of young people these days start first by learning how to code in Python and start later follow up with understanding how markets work. And I think the underlying driver for all of those algos, for any sort of quantitative expression, is understanding how the markets work. And most of those quantitative models are taking a lot of technical inputs and probably some fundamental inputs into their multi-factor model. So we're going to talk a little bit about that systematic evaluation today as well. All right, those are some of the textbook definitions. Here's how we say it at the CMT Association. We believe that technical analysis provides the tools to successfully navigate the gap between intrinsic value and market price across all asset classes through a disciplined, systematic approach to market behavior and the law of supply and demand. Now, I got to work with some incredibly smart and very experienced money managers who are on our board of directors and elsewhere in the organization to come up with that positioning statement for technical analysis. And where we really started was with these blog postings from Professor Aswath Damodaran. If you're not familiar with Professor de Montmorin, he is a incredibly prolific author, frequent speaker at CFA Institute events. He is a professor at the NYU Stern School of Business, and he is the guru of fundamental analysis. This gentleman lives and breathes discounted cash flow statements. He writes extensively about valuation models and modeling of new IPO entrants to the market. But in his blog writings, he had this nagging question about why the market is so often wrong. Why does the market misprice securities? And that the answer that he came up with was that intrinsic value was driven by a set of variables, accounting side, fundamental side variables. But that market price was driven by other factors that weren't accounted for in those models, things like market sentiment, supply and demand relationships, etc. So it was from his curiosity about why the market was mispriced that we came up with this definition. Now, Ralph Acampora, who co-founded the organization, asked me that anytime I was talking to a group of people about technical analysis, that I borrow this slide of his from his decades of teaching at the New York Institute of Finance. And in Ralph's day, the mega cap security of the day was IBM. We're going to use Apple as the example today. Now, thinking about Aswath Damodaran's ideas of value being different from price, and that technical analysis helps us navigate that gap, let's just think about how we analyze a security, right? We could pay attention to the company. And this was everything that was taught to me in my MBA program, right? We want to understand the valuation metrics for any security, and we might look at a number of different ratios, right? Price to earnings, price to book, price to sales, all of those valuation ratios and the models with a bunch of estimates that go into valuing a company. We also care about the quality of the company, right? So we want to know if the shares are expensive relative to this intrinsic value idea, but we want to look at the company, the quality of that company. So we look at the management team. Are they very efficient or inefficient at allocating capital throughout the team? What's on their balance sheet? Do they have a strong cash position? Do they have huge debt, and is servicing that debt going to be a headwind for the firm? We want to look at the growth factors, things like return on equity or margin expansion. We want to look at the quality of those cash flows. And of course, we want to understand their product mix, what's going to generate those future cash flows that we're going to put into our DCF statements. And there's a whole competitive landscape. And I'm not just talking about, is somebody else coming out with something better than the iPhone 15? Of course they are. But we're talking about the regulatory landscape. Maybe in certain industry groups, it's the environment and competing factors around climate crisis. You name it. There's a world of complexity in the top half of this graphic. Now, that fundamental information is critically important. And I am not, by any means, diminishing the value of understanding what's happening inside of companies. If you're an equity investor, by all means, understanding what that fundamental information is telling you, coming up with a way to analyze and value companies is very, very powerful. However, if we are not a gigantic private equity firm, we're not buying the whole company. We are buying shares of that company, right? The stock is also part of our analysis if we're going to have a complete view of what our investments are telling us. And so the rest of the picture comes from analyzing the stock. And that stock has a price at which it is trading, volume at which it trades at any given price. We're going to look at things from, the futures market, like open interest, commitment of traders. There's, back in the 60s, people looked at odd lots. There are data sets from the market itself that are incredibly powerful. Today's options industry is giving us the most valuable data sets and more information to process than ever before. We can look at supply and demand relationships, not just for Apple shares, but for the information technology sector or for growth companies versus value. We could look at supply and demand for US equities versus the rest of the world, or equities versus other asset classes like gold or Bitcoin or commodities, you name it. We have a lot more to analyze down here to get a complete view of our investments. And of course, that last bullet point is the psychology of the market participants themselves. And that is perhaps one of the most powerful things that I have learned in my time at the CMT Association from these incredibly brilliant men and women. This next slide, if there's anything that you take away from tonight's presentation, I hope you pay attention to this part. And I'm borrowing this from David Lundgren, who is my co-host on Fill the Gap, that podcast I was talking about. He's a veteran money manager, a dual charter holder, a CMT and a CFA. He's also been a professor at Brandeis University. He is a wealth of information, a fountain of great things to understand about investing. Now, he came up with this equation. You don't have to write it down. It's for illustrative purposes. But to understand this unbreakable link between fundamentals and technicals, let's use this equation. And the equation says that price is equal to the fundamentals, the growth factors, and the valuation of the firm, right? Price, or technical analysis, is simply earnings per share, right? The growth factor alongside the value. You multiply those two, you should get a result in price. Now, every CMT charter holder on the planet will tell you that long-term price trends are always going to be driven by the fundamentals. We all believe in this in one form or another. Now, the other thing that this equation tells us is that the entire industry is in this together. So if you hear somebody saying, I don't believe in the technicals, they're nonsense, that's voodoo, I don't use it. Well, that's unfortunate, because the price is dependent on the fundamentals, and the fundamentals are dependent on the price. We both need cooperation from each side of the equation in order to be profitable traders and investors. We need cooperation between the two over the long haul. All right. Now, the other thing to recognize is that price is driven by our growth factors and our valuation estimates, but it's all magnified, emphasized, amplified to the power of investor behavior. And that behavioral psychology is something we could talk all night long about. We could go through the work of Daniel Kahneman, our 2002 Nobel Prize winner in economics. He's an incredible behavioral psychologist. If you haven't read Thinking Fast and Slow, I recommend it. I reread it every year. And some of that groundbreaking work that he and Amos Tversky did in the 1970s around prospect theory has led the behavioral economists of the world to new heights. They're discovering new things every day. Now, we know that in a bear market, right, when everyone is very downtrodden, very despondent on the marketplace, and just think back to how you were feeling about trading middle of 2022, or the end of 2022, I should say. That behavioral element can impact, even if the fundamentals and the valuation are really, really strong. Companies are posting earnings growth, they've got strong balance sheets. It doesn't matter if the investment public doesn't want to own equities. If they're all in cash, then that supply and demand relationship for those shares of stock, it's not going to go up. It's amplified to this behavioral element. We also know that in a raging bull market, right, rampant enthusiasm, irrational exuberance can extend prices well beyond any kind of intrinsic value rationale for the share price of those equities. All right, let's keep going. What are the differences in each side of the equation? Well, on the right side, if we were to click on this F and open it up, right, if we were trying to understand company growth, there is an incredible amount of information there, right? Return on equity or margin expansion. We could look at a dozen different variables, each of which we'd have to clarify, and they're all forward-looking estimates, right? Now, what about on the V? If we open that up, there are a dozen different ways to value a company, and everyone's valuation model is going to look slightly different, and it's also estimated information. And then how about this B? I don't even know any sentiment analyst out there. And there are incredible folks out there who are doing deep work on, the pipeline of social media feeds and frequency of positive or negative commentary and what that might mean about trading behavior and positioning for market participants. There is no clear-cut answer for any of these. They are incredibly complex, and they are often estimated. On the left side of the equation, we have price, which is just price. It's a fact. It's factual. The closing price of any period, whether we're talking about the end of the trading day or the week or the month, it's not an estimate. That's actually where trading stopped and where buyers and sellers agreed on a price. And it doesn't, it's not an estimate, and it doesn't ever get restated. It doesn't get revised. It doesn't change after the fact. And that elegant simplicity, what it tells us is that everything on the right side of the equation can be distilled down to a metric that is stable, and it's factual, and it's consistent. And what we know about investing is that the market itself is one of the greatest fundamental investors on the planet, is the greatest fundamental investor on the planet, because the market is distilling all of the information that we know about, right? All of those valuation and growth estimates. The market is distilling all of the behavior of every market participant in real time. It knows everything that we know about the market, everything that we will admit to not fully understanding. But it also knows things that we couldn't possibly know, right? Market price moving down precipitously for Enron long before anyone understood the kind of shenanigans that were happening with the auditors and accountants. How about Sam Bankman-Fried, the FTX blow up? A week before FTX blew up, the smartest folks in the room, the private equity investors, gave him a check for $5 billion. These are the folks who do due diligence to the T, and they didn't know, didn't understand, couldn't unearth what potentially could go wrong. Price can figure that out. The market can figure that out. So going back to Damodaran's blog post, wondering why the market is so often wrong, or rather approaching the market every day with your opinion that the market is wrong and that it will correct, it will revert towards a intrinsic value estimate that you've come up with, is a very difficult way to invest. It's not impossible, but it's very difficult to come in and hope that the market sees your view. Now, as technical analysts and as trend followers, we believe the market is always right. We don't try to predict the future, but rather react responsibly to what the market is telling us, okay? So there's a lot of simplicity on the left side of the equation. And we know that we all agree on the importance of those fundamentals. We've just simply hired the market to be our fundamental analyst, okay? And every morning we check in with our fundamental analyst and see whether the value and the growth factors or the behavior have changed from the prior session. And I guess the last point to make is that trend following investing is actually universal. So if you're a deep value buyer and you want to get in on something that's been demolished by 90%, you're also hoping that there will be a trend in price moving in that direction. We simply wait for that trend to be articulated before we get involved. So it's just a timing decision. Now, I've talked a little bit about the behavioral elements and about how markets move. Let's keep cruising past this, and I'll let you all read Daniel Kahneman's book on your own time. Remember when we were talking about supply and demand relationships? If I take you back to your Econ 101 class, you'll remember that at a fixed rate of supply, an increase in demand is going to move us up this price equilibrium, right? Price will be higher with an increase in demand. Similarly, if we increase supply, right? We have a supply increase, price will go lower as we move down the price equilibrium. So when you think about support and resistance levels, or about buyers and sellers, buyers are generating demand and sellers are generating supply. They have an effect on price. And when we come back to that equation, when we think about the fundamental and the value side, we know that that demand and supply relationship can put prices well above or well below any kind of intrinsic value. I'm not sure if anybody on this call traded through the meme stock craze of 2021, but AMC, right? A movie theater chain here in the US. We had a pandemic where everyone was sheltering in place, not going out to the movie theaters. But price rose precipitously in the anticipation of crowds going back to theaters. There were buyers when price had really plummeted. But that irrational exuberance, the short squeeze that happened to Melvin Capital, this pushed price well beyond any kind of intrinsic value. And we can see that that behavior element can change price dramatically. We also know that over the long term, without cooperation from the right side of the equation, the fundamentals and the growth factors, price will correct. Price cannot sustain these levels of irrational exuberance. How about GameStop, right? I love these meme stocks. These are going to be textbook examples for 100 years from now. And then, of course, the entire cryptocurrency space, which frankly, I'm a believer in. I just don't know how anyone can come up with an intrinsic value, not necessarily for Bitcoin, but think about all those lower level protocols, the coins themselves. I understand distributed ledger technology has a tremendous value, and this is the way to get invested. But what is the intrinsic value of any of these individual coins, right? We're only trading supply and demand. We are trading price action when it comes to asset classes like the cryptocurrencies. Now, why is price so important? Mark Abraham is a celebrated trend-following hedge fund manager. He's been very successful, and he's written a lot of work on his process and approach. I love this quote. He says that ultimately it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down, and that consensus is revealed by analyzing price. There is a tremendous amount of information encapsulated in a very elegant, simplistic, and factual data point. All right, thank you for sticking with me, friends. We've made it through the first section. I'm going to dive into a couple of technical concepts, these tools that can help us with our decision making. You've already learned all day long from some real experts in the field. The three that I like to cover are relative strength, breadth, and divergence analysis. And conceptually, we're going to cruise through these just in the interest of time so that I can share with you a little more about the CMT program. So let's dive right in. Relative strength, I'm pulling this definition right from Martin Pring, but the core concept of looking at charts, right? We can identify trends, we can look at absolute price action, but what if we wanted to compare to securities? What if we're trying to decide which one to put into our portfolio? So for a lot of the asset allocators out there, they're looking at factor investing. Do they want to own growth? Do they want to own value? They might look at market cap, large cap, mid cap, small cap names. But let's just compare growth to value for a second. Still using the COVID pandemic as our textbook example. These are growth shares in this top chart, value shares in the bottom. And if we were just to eyeball the two charts, looking at their price action, we might come to the conclusion that generally they've moved exactly the same, right? They were rallying, they both came into the COVID collapse, they rallied out of the collapse, and maybe there's some divergence here on this right side where we're seeing value outperform growth a little bit. This chart goes through 2022. Well, what we can use is the concept of relative strength. We can look at a ratio of those two charts, S&P growth over S&P value, and when the line is rising, growth is outperforming value. And when the line is falling, value is outperforming growth. Powerful concept. A couple things to point out here. Growth began to outperform value significantly weeks ahead of the index collapse. So the market knows more than we could possibly know about the impact COVID might have, that stay-at-home economy, the K-shaped recovery. Growth started outperforming value into the downtrend and then continued out of that V-shaped recovery. Now, relative performance, here's another note to put in your notebook. It doesn't mean that the security isn't also trading down, right? Just because growth is outperforming value, on an absolute basis, they were both in downtrends. But a rising relative strength line means that this is going down less, right? Growth stocks were outperforming growth. Growth was outperforming value, meaning it was losing less on the way down and gaining more on the way up, right? Rising faster. And we can see at these points on this relative strength line that there was outperformance and underperformance. Interestingly, this underperformance of growth versus value happened as we saw rapid inclines in US Treasury rates. And we'll talk a little bit about that in a minute. But the context for investing, relative strength is about comparing to securities. And that trend of the relative strength line is all important. So let's use another example. Does everybody remember all the way back to February of 2023? Here we are coming to the end of the year, and we're seeing bank stocks outperform. We're seeing the financial sector outperform. You wouldn't think that was the case, right? Emotionally speaking, I think all of us by the end of March were pretty bearish on the financial services industry. And this chart up here is regional banks. It's an ETF proxy for all the regional banks, and this is the XLF, the broad financial services sector group. Now, again, eyeballing, regional banks underperforming, and then they both crashed, right? When we look at the relative strength line, it reveals a little different picture, which is that regional banks were outperforming the XLF, right? You wanted to own regional banks through the end of 2022, and it was here at the end of October 2022. Remember, the news headlines at the end of February for Silicon Valley Bank and Signature Bank, these collapses, and you remember how dramatic it was. It was a run on the banks at the same time that the tech sector was blowing up, right? We're coming into perhaps the worst case scenario of a great financial crisis plus the dot-com bubble bursting. Investors were terrified. But we saw regional banks outperforming the XLF, and then months before that collapse, months before the regional banks had their liquidity crisis, we saw them underperforming dramatically. Again, the market knows all. Somewhere, someone was doing the work to understand the debt holdings on these regional banks and what kind of magnitude move it would take in the US Treasury markets to change the interest rate on the debt servicing that they had to do, and the fact that they were vulnerable. They were higher risk securities than the rest of the financial sector. So you start to see this underperformance of regional banks against the XLF well ahead of the collapse. What do we want to own in XLF going into something like that? Insurance companies, broker-dealers, technology companies, those were all outperforming the banking sector and regional banks specifically. All right, so another few slides that Dave has used in classrooms at Brandeis and elsewhere. When we talk about how inextricably linked fundamentals and technicals are, this concept of relative strength is really important. I'm just gonna go through one for illustrative purposes, right? We could rank all the industry groups of the stock market, and as we're thinking about what we want to own, right? The market's going to tell us what it cares about from a technical perspective, from a growth metrics, and then from a quality and a value perspective. So in the first column here, we've got the momentum ranking, right? Technically, these are the areas of the market that are outperforming. This is what we want to own. Here's what we don't want to own: underweight these areas or short these areas of the market. But look how they line up with some of the fundamental factors. Well, the midpoint right in here, we want to overweight these, we want to underweight these. And what the market is telling us is that expensive companies, right, their valuation factor, these are the shares that are expensive relative to their share price. Expensive but profitable is working. Investors are allocating to securities that are both expensive but still profitable. And that's context, right? The fundamental factors may change. These leadership groups on a technical perspective might change through time. Value may become a really important factor later on, and it might not be profitability. It might not be, investors might not be looking for growthy companies in certain segments of the business cycle. Let's look at this on a sector basis, right? Let's say we're considering the semiconductors, right? And you're an analyst in that sector group. You're going through the COVID crash, but you're seeing semiconductors relative to the S&P 500, the benchmark, they're all outperforming. Every single one, and I've taken the names off because it doesn't matter, right? Every single one of these chips manufacturers, and not Frito-Lay's, semiconductor manufacturers are outperforming the S&P. So if you're a sector analyst, you want to give your portfolio manager some guidance. What do you want to overweight and what do you want to underweight? A generalist portfolio manager might say, well, they're all good. yeah, everything in that ranking list is just fine. Maybe we leave out the last one. But a sector analyst is going to rank these not only on their relative strength to the benchmark, to the S&P 500, but relative to the semiconductors industry group, right? We want to own the stuff that's outperforming the industry group, that's outperforming the sector, that's outperforming the benchmark. So we could look at a couple of charts, and this is where that data visualization becomes so important, right? Context is key. Yes, both of these companies are in an uptrend, but look at the different context. This was in a defined downtrend, while this was in a defined uptrend ahead of the pandemic collapse. And yes, they're both rising. This chip company number 15 is just in an industry group that's outperforming. And in today's landscape of ETF investing, there are a lot of folks that are just equally invested in every share in that sector group or in that industry group. If we look at this relative to the S&P, it's the blue line. Relative to the semiconductors industry group, it's the red line. It's outperforming both. This is a strong buy. This company number 15, relative to the S&P, it's holding, it's flat, but relative to the semiconductors, it's an underperformer. This is an opportunity for maybe a short or at least underweighting. And there are more in this series that I could go through and give you additional examples, but let's move on to the concept of breadth. I like to talk about the 1990s Chicago Bulls, right? What a powerful team. Everybody thinks about Michael Jordan, right? Star player. And we certainly all wore his jersey and wore his shoes, but it's not a stock market. It's not a single player. It's not just the equity index. It is a market of stocks. And when we look at market breadth, what we're talking about is bench strength. And those 90s Chicago Bulls, yes, they had Jordan, but they also had Scottie Pippen and Dennis Rodman, and they had players in every position who knew how to do their job and had, the greatest rebounds in the league. They had the greatest, defensive players, the greatest offensive players, and of course they put the ball in Michael Jordan's hands whenever they could, and he was an incredible scorer for the Bulls. When we are looking at markets, it's important to not just look at the equity index, but to think about what's happening under the hood. And tools like the advanced decline line, it's a very simple calculation of up movers and down movers. You can look at on balance volume. There are scores of indicators out there to cover this concept of market breadth, but the bench strength is what I'm talking about. Here again, another example of the pandemic crash. We're looking at the Russell 2000, the IWM ETF. These are weekly candles. And the advanced decline line comes up here and peaks out well ahead of the collapse, right? We see a rapid decline in market breadth ahead of the index rolling over. What does that tell us? It tells us that the average stock within the Russell 2000 had started to underperform well ahead of the broad knowledge of this COVID collapse. So when we see that, when a market index makes a new high on weaker and weaker breadth, when breadth is deteriorating, it's a leading indication of what may be happening under the hood and how that could potentially affect the whole index. Similarly, when we see these areas of stagnation, right? The index is rallying off the lows, but we're not really seeing breadth improvement. Well, holding the index, that's rewarding to portfolio managers and their clients. They've owned the index through a rally. But now, what about this area where the Russell 2000 at the index level is really doing nothing? But under the hood, the expanding advanced decline line tells us that there were lots of new trends emerging, lots of rotation between the different sector groups, lots of new leadership emerging, and that rotation is the lifeblood of bull markets and of returns in your portfolio. So if somebody tells me that, hey, the S&P 500 is going to be at 4,600 or range bound between 4,700 and 4,300 for the next 10 years, I would say, oh, that's going to be really, really unfortunate for the passive investors, for people who are just buy and hold indexers. However, there could be incredible opportunities, stealth bull markets, exploding rallies in lots of different sectors, industry groups, individual names, and there is an opportunity to capture a trend no matter what the index level is performing. Right now, it has been the story of the Magnificent Seven. Going through this year, this rally has been diminished by very bearish minds on the subject, and they have pointed to market breadth as their main cause for concern. Right now, we're seeing some of that breadth expansion. We're seeing the Russell starting to catch up, and I'm certainly seeing that as a very bullish sign. All right, last idea to think about tonight, divergence. And this could be used with any indicator, whether we're talking about breadth studies, momentum studies, volume, you name it. You can think about confirmation and divergence as simply using your suite of technical indicators to help confirm or deny what you're seeing in price action, right? As Edwards and McGee told us, technical analysis is really focused on supply and demand. The price action itself is our paramount indicator, but we can use these other derivatives to give us leading indications of what might be coming next. Now, here's just the classic illustration of bearish and bullish divergence, right? So our security is making a series of higher highs, while in this case, a momentum oscillator is making a series of lower highs. The enthusiasm of buyers in the marketplace as this stock creeps up to ever higher and higher prices, well, that enthusiasm is waning. It's still positive. There's still positive momentum, but it has diverged from the price trend, saying that at some point, this exhaustion will run out and price will struggle to go higher. That's how we think about bearish divergence in an uptrend, or bullish divergence, right? We're in a downtrend, we make a new lower low, and our momentum oscillator makes a higher low. Yes, still negative momentum right here where my cursor is, but it's diverged from the price action, meaning that price may struggle to go lower after that divergence. So a key concept. Now let's think about this in the context of major long-term macro charts. This is a chart of the TNX, the 10-year US Treasury yield. Yours truly was born somewhere right around here. I basically top-ticked the market. Gave way for Reagan era and for my parents to refinance their mortgage every 5 years as it went from 17% down to 0. Now, the divergence on this chart is a decade long, right? The trend of US Treasury rates made lower and lower lows, while the MACD was making higher lows subsequently at each peak. So we've got a multi-year divergence. And of course, what we have seen recently is this explosive move, first reverting to the mean, right? Coming back to that 200 period moving average. These are quarterly bars, by the way. This is going back 40 years. But then beyond the mean reversion to a new secular trend in interest rates. And that's something for everybody to keep in mind when we're thinking about, the narrative or the approach that we take to markets. What are we thinking about scenario planning for 2024 and beyond? For 40 years, nobody has traded through a substantially rising interest rate, right? There were moments, there were multiple years of rates rising, but rising in reversion to that mean, to that long-term downward sloping trend line. This is new, folks, and you got to go back to the 1970s to find corollaries about what has worked. You can look at the 1950s, which was a rising rate environment, but also a bull market for stocks. So I'm not saying that it's all bad news, but it's a very different secular regime that we are in. Enough about divergence, and I'm going to just blast past these two. Talking about money management principles is something that you are going to learn in depth in the CMT program. Here in our last 5 minutes together, I just want to touch on a few of the basics about why I decided to go through the CMT program, why I have seen tens of thousands of others start to apply their free time and their talents and their skills to studying the tools of technical analysis. All right. First things first, it is a living body of knowledge. Technical analysis is a very dynamic toolkit. It has changed dramatically since the organization started in the 70s and continues to evolve and change as new technologies come into the markets, new asset classes emerge, new data sets come out of the markets. And hopefully for anybody who's considering this program, first you're thinking about, well, what is it going to do for me in my career? And that's where we start in creating the CMT curriculum. We go out to all of the hiring managers in the industry. We talk to the head PMs and the CIOs. We talk to the heads of the trading desk, the directors of research, and we ask them, what are the knowledge, skills, and abilities you are looking for in your next hire? If you're going to bring somebody onto the team, what do they need to know how to do? And it's through that survey work that we do every few years, and we survey thousands of individuals, including all of our charter holders, to find out what's most important. And they came back with pretty clearly defined few categories. Number one, you got to understand risk management, and that has been at the top of the list since the great financial crisis. We also know that it's very important for any new hire to understand quantitative systems development. They need to understand how to use evidence-based investing strategies, and they need to be able to quantify what it is they're seeing on the chart. What's the validity? What's the probability of returns 30, 60, and 90 days after a signal is generated? How do you evaluate a trading strategy systematically? What's the Sharpe ratio? Monte Carlo simulations, forward and back testing, you name it, it's in the CMT program. And I apologize for those of you who hate statistics. You will actually learn to love them as you go through all three levels. It's all done in the context of a portfolio manager. So instead of thinking about technical analysis just for single security trading, we go beyond that to think about the correlations between securities in the portfolio, correlated risk or correlated returns, how you can get differentiated alpha out of different kinds of trading strategies, multiple timeframes, you name it. And then there's a lot of application of concepts in behavioral finance. And that is not only how the market works at a macro level, what these behavioral forces are that drive markets, but also at an individual level. Where can we fall victim to overconfidence bias, to looking for confirmation from our market data sets, and where we can combat our own behavioral pitfalls. So I keep talking about this CMT program. Chartered Market Technicians, here's what it is. It is a global credential recognized around the world by employers and regulators that establishes a level of excellence and professionalism in technical analysis that supersedes all others. Now, it's 3 exams as well as a professional membership in the organization. So everyone abides by the same code of ethics and standards of professional conduct. We actually share that ethics alignment with CFA Institute, Kaya, and other well-respected designations in the financial services industry. Those 3 exams have to be taken in sequence. So you can't move on to level 2 until you've passed level 1, level 3 after level 2, et cetera. And we only allow candidates to take 1 exam per cycle, meaning you're going to need a few months to prepare this material to sit for the exam. And I know some of you may have been doing this for years, and I'm sure you will find the information very familiar, very accessible. But I think, for our candidates, we've had a very diverse set, some 30-year veteran portfolio managers that come into the program, and they're shocked by how much new information, concepts they had not heard of or used before, the fact that they had a way of using something that actually wasn't correct, right? They were misinterpreting some of the tools on their charts. So we do encourage everyone to take those exams one at a time, to dedicate the time that you need to your study. The exam cycles are offered twice a year, once in June and once in December. For any of the CMT candidates who are sitting their exams right now this week in December, I'm wishing you every success. And if you're tuning into this webinar, hopefully you're not going to be up all night studying. But the exams are very academically rigorous. Pass rates on the level 2 exam have been around 50%. Pass rates on level 1 are right around 65, and the pass rates on the level 3 exam are in the low 70s. So the next chance to sit for the exams is going to be in June 2024. For those of you who are thinking about it, you've got plenty of time to study. Registration is actually open right now at CMTAssociation.org. We have a long exam window, a couple of weeks in June and a couple of weeks in December. The level 3 exam is actually administered all over the world on the same day, so that we can ensure high integrity on the exams. We've talked a lot about technical tools today, but there are lots of knowledge domains covered over all 3 levels. And you can check out the learning objective statements right on our website and through the CMT program guide that I'm happy to share with all of you. The curriculum itself, it's published by UWorld Finance. They actually just acquired John Wiley & Sons. If you've been watching this presentation for a while, it's a new hyperlink to finance.uworld.com. That's where you will find the official CMT curriculum for 2024. That will be available starting December 14th. So in 3 days' time, you can set your clocks. But the 2023 and prior editions are also widely available online. Just wanted to encourage everybody who's thinking about getting started in 2024, you can pick those up right from UWorld. Now, a lot of study. It's a difficult exam. Why would anybody apply all of their free time, their nights and weekends to sitting for this rigorous series of exams? For me, and for a lot of the survey work that we do and a lot of the member conversations I have, the first and most valuable thing is that it is a structured approach to technical analysis. There's a ton of content out there online. You can learn from some real experts, particularly on these MetaStock summits. However, if you are starting from the basics and starting with a very professional and responsible approach, you're going to want to learn a broad range of coverage. And it's not going to be from any one expert in any area. It's going to be across all of the tools and concepts of technical analysis. We also know that people really appreciate the program because it is such a complementary toolkit. And the way that we present technical analysis is for investors of all asset classes and all stripes, even for fundamental investors who want to get some confirmation from price action in their decision making. We know that on the job market, it presents a ton of differentiated value. There is a high concentration of financial planners or of financial analysts with the fundamental background. A lot of folks did an MBA just like I did. But the CMT is still a very unique and very, I guess, elite designation for a few select money managers. And so differentiation on the job market can be really powerful. If they're looking at 10 candidates who are all highly qualified, and you're the only one with the CMT after your name, that presents a different way of thinking that could really benefit the firm. Now, we also do surveys of what happens after you get your CMT. And the survey results from charter holders 1 year after completing and earning their designation include lots of things like promotions and higher salaries and new positions, and they get contacted by recruiters and headhunters and all the rest of it. This is the data point right here that actually I wanted to point out, and that is a little over 60% of the survey respondents a year after earning their CMT reported having higher responsibility, more responsibility in their fund. And what that translates to is expanding AUM. So whether their firm was allocating more capital to their trading strategy or clients were bringing more money to work inside their investment vehicle, what it tells us is that firms and clients alike can attest to the responsible process that CMT charter holders use to manage money, to capture alpha, and to minimize risk in the marketplace. And that's just a really powerful testament to us that the industry has recognized the value of CMT for their employees and their money managers. Now, for those of you who are CFA charter holders, we did a very long, lengthy exercise of curriculum mapping, and we found that CFA does cover a lot of the same topics throughout the 3 levels of CFA that allows for an exemption on CMT level 1. So if you are a CMT charter holder, you can actually begin your test taking on the CMT level 2 exam. You're still responsible for all the material in level 1, and yes, there are some things that are scaffolded through the 3 levels. So I would encourage you to pick up the level 1 textbook as well. For more information on how investors and analysts think about melding the 2 and combining fundamental and technical analysis, we've got a ton of testimonial videos and some really interesting interviews on our website under the CMT program, under that link for the CFA waiver. You can hear from money managers all across the industry on why they chose to do both a CMT and a CFA. So that is for our CFA charter holders. For those of you who are students in our academic partner program universities, I appreciate you tuning into this MetaStock webinar as well. I use this little image of Katie Stockton. She actually finished the CMT program while in undergrad at University of Richmond. And it was the University of Richmond that actually was the first school to ever teach a fully accredited technical analysis program. So we have expanded that outreach to over 70 universities around the globe. We do offer scholarships to the students of those schools. If you're currently a full-time undergrad or graduate student, you can reach out to me, Tyler at CMTAssociation.org, or hit us up with admin at CMTAssociation.org. Just use that word scholarship in your subject line, and we'll make sure to send you all the information about that academic partner program. So that really brings me to the end of what I wanted to talk about today. I encourage all of you, if you're thinking about, maybe you don't want to hit the gym and go on a diet in January, maybe part of your New Year's resolution is to think about investing lots of your time in studying this material in a structured way to improve your investment decision-making and to expand your career opportunities. So that's the process. We encourage you to enroll in the CMT program. You'll sit for those exams in sequence, and I'll be right there with you to celebrate your success on the other side as you become a CMT charter holder. So by all means, feel free to contact me if you've got any questions. Email's fine. You can reach me on, what is it now, X, or connect with me on LinkedIn. I appreciate you guys sticking with me. I know it's 6 p.m. Eastern, and Jeff is now on hour 10 of online education. But I really appreciate the chance to share this with you, and looking forward to lots more events in the years ahead.